There are plenty of examples of taxes that people consider to be unfair. I don't know many taxpayers who are fans of any of the taxes they pay, but some forms of taxation can feel less fair than others. One example of a widely perceived unfair tax is the high income child benefit tax charge. I was paying this one for a bit until we opted out of child benefit, and it's pretty unfair for one big reason, which I'll come on to in just a moment. Keep watching this video if you're caught out by the high income child benefit tax charge, as there is a way to use pension contributions to fall back under the threshold for this tax. In fact, you could add £10,000 to your pension pot each tax year at a cost of just £3,500. I'll explain how in this video. But why do I think it's so unfair? The high income child benefit tax kicks in when one member of the household earns more than £50,000 a year. Simple enough. But that threshold system means the tax applies when one partner earns £50,000 and the other earns nothing. But it doesn't apply when both partners earn, say, £49,999 a year each. So you've got this potentially unfair situation where it's not household income being assessed, but instead the income of the highest earner. There are households earning well in excess of the £50,000 threshold, but not being taxed to recover their child benefit. And there are households where one partner earns more than the threshold, the other earns nothing or very little, and they have to pay the child benefit back through a tax charge. This £50,000 threshold for the high income child benefit tax, introduced all the way back in January 2013, has remained unchanged since its introduction. The tax charge captures an awful lot of families, with the Treasury collecting a total of £2.5 billion in high income child benefit taxes to date. The figures, which were revealed in a Freedom of Information request from NFU Mutual, also show that HM Revenue and Customs has saved around £4.3 billion as a result of families opting out of child benefit. More than 500,000 families have opted out of child benefit, so they don't get it anymore, as a way to avoid paying this tax charge. With wage inflation since 2013, when that tax charge was first introduced, and the £50,000 threshold remaining static, NFU Mutual is warning that basic rate taxpayers will be caught up in high income child benefit tax unless the threshold is reviewed. Sean McCann, who's a chartered financial planner at NFU Mutual, said, "These figures show the government has clawed back billions through the child benefit tax charge. The £50,000 threshold hasn't changed since it was introduced in 2013, meaning that more and more families have been caught as incomes have increased. In 2013, 40% income tax was payable on income over £42,475. The £50,000 child benefit threshold was set at a level perceived to be high income. Since then, the point at which 40% income tax becomes payable has risen to £50,000, while the threshold for the high income child benefit tax charge has remained the same. If, as expected, the threshold for paying 40% income tax increases above £50,000 in the budget, we could see some basic rate taxpayers impacted by the charge for the first time. Recently, HMRC has engaged in a crackdown on those who have failed to declare and pay the high income child benefit tax. The number of compliance checks made by HMRC almost doubled, from 63,591 back in 2018-19 to reach 125,594 in 2019-20. Nearly all of those compliance checks resulted in a tax charge, with 96% of the checks leading to a tax bill. Sean added, "Many are unaware of this complex tax and the fines for failing to pay it, even if you're paid through PAYE and don't normally complete a tax return. If you're the highest earner in your household with income over £50,000, the onus is on you to tell HMRC and pay the tax. If you have a pay rise or move in with a new partner who claims child benefit, you could be caught even if they're not your children." The good news is that anything you pay into your pension is knocked off your income before the charge is assessed. If it reduces your income below £50,000, you won't need to pay the charge. As well as generating £2.5 billion in taxes to date, the high income child benefit tax charge has prompted more than 500,000 families to opt out of receiving child benefit. That saved the Treasury £4.3 billion to date. That's a lot of money. HMRC confirmed in the Freedom of Information request response, taxpayers or their partners may opt out of receiving child benefit payments as an alternative to paying the high income child benefit charge. charge. Consequently, these figures do not reflect the total impact on the government's finances from the introduction of high income child benefit charge. NFU Mutual used the published 2011-12 child benefit expenditure as a benchmark and estimated the total savings for the government to date at £4.3 billion. According to official figures, child benefit payments have fallen significantly since 2013, with HMRC confirming that people opting out of the benefit is the driving factor behind the fall in spending. As I mentioned near the start, one planning strategy that you can use to save on this tax charge is to contribute more to your pension pot. Pension contributions are deducted from your relevant earnings when calculating this liability for the high income child benefit tax charge, and in some cases that can take you below the £50,000 threshold, or at least it can reduce the amount of tax that's due. For example, if the top earner in a household earns £60,000, they could save £4,500 a year by paying £8,000 into their pension pot. The £2,000 tax relief on top of the £8,000 contribution would take their taxable earnings down to £50,000. Not only would they save £2,500 from a child benefit charge, but they would also take their income below the 40% tax charge. For a family with 3 children, this would result in an extra £10,000 in their pension pot at a cost of just £3,500, with a total of £4,500 saved in tax. Of course, this ability to save on the high income child benefit tax charge depends entirely on your circumstances, and nothing in this video is advice. If you're unsure, please do seek professional advice before you take any action, as always, as with all things. With the budget coming up on the 3rd of March, we can only hope that Chancellor Rishi Sunak takes some action on this unfair tax charge, perhaps inflating the £50,000 threshold just a little bit, so fewer taxpayers are caught up in the tax charge in the future. Who knows, it might happen. Do let me know in the comments if this high income child benefit tax charge catches you out, especially if you've opted out of child benefit to avoid paying the tax, or indeed if you've been able to make use of smart pension contributions to bring your relevant earnings under the threshold. I always like to hear about good financial planning stories. Thank you for watching this video. Until next time, I'm Martin Bamford, and remember, when it comes to your money, the more you know, the faster it can grow.